Hello everyone, today I'm going to discuss on 3 hot stocks and 3 not so hot stocks in the near term, say about 6 months. And this video is going to be a summarized and bite-sized version as I highlight only the key points. Feel free to comment if you want elaborated views. But before I dive into the details, as usual, hope you can help with the YouTube algorithm by liking this video. Your little support means a lot to me. First up, Tesla, huge total addressable market in EV industry, market leader, rapid increase in production capacity, high profit margin, lots of free cash flow, visionary leader, various technology S-curves in full self-driving and robotaxi, as well as AI and Tesla bots. What else can you ask for? Tesla is a futuristic company with world-class executions for its business. I think we may not ever see a company of this magnitude in the next 2 or 3 generations. Personally, I believe their products will continue to grow for multi-decades, and if their idealistic concept of FSD, robotaxis and Tesla bots fail, they can still fall back on EV. Their dominance in EV is undisputed. As you can see, while Tesla is currently pumping out EVs at a record-breaking rate, many giant legacy car makers are still sorting out their EV plans. With 2 more gigafactories coming up, Tesla is just going to extend their lead further. I'm quite sure many analysts did not factor Tesla bots into their price target, and without that, they are already forecasting that the price will go above $1,000. So that is like at least 15 or 20% upside from current price. In my opinion, anything that is below $1,000 is cheap. Given the current weak market sentiment and various macro factors, I wouldn't be surprised if it hits $700 or $600 range, which spells massive buying opportunity. But I don't think it will go below $600. Among the top 10 US mega cap companies, Tesla is probably the one that is growing the fastest. I think it will overtake the top 2 firms in US, which are Apple and Microsoft in terms of market cap. But that's some years from now. However, in the next 6 to 9 months, I think Tesla is going to fly from its current price range of $800. Second hot stock, Disney. The company reported a solid Q4 earnings. Firstly, Disney Plus subscriptions beat expectations, and this contrasted sharply against Netflix's disappointing Q4 results, which they reported slowing subscriber growth. Secondly, Disney Parks, Experiences and Consumer Products division saw their revenue double in Q4 2021 when compared with Q4 2020. Looking ahead, here are some good news. Their management team expects subscriber growth for Disney Plus to be stronger in the second half of the year. As for the theme parks, their recent earnings mainly came from their domestic parks. However, as the world starts to co-live with COVID-19, I foresee the international travels will go up from this point onwards. And this means the theme parks will also continue to recover to its pre-pandemic levels. And the icing on the cake is that we will see lots of pent-up demands and spending from travel-deprived tourists. And don't ever underestimate this revenge spending. It's a psychological thing. Lots of tourists will unleash and splurge the cash that they have saved up on traveling over the last 2 years. Another thing to highlight, unlike its competitor Netflix, which solely depends on its streaming service, Disney had the competitive advantage of integrating its multiple segments of business. They can bring the content from Disney Plus to real life and vice versa. And with its strong brand, Disney definitely has more ways and sources to monetize its streaming content. Next up, Google. I think there are very few companies in the world that can dominate a sector by more than 90% and turn their signature product or service into a verb like Google this and Google that. And beyond search, the company is also a leader in online advertising space. Unlike Facebook, who gets affected by changes to Apple's iOS, Google has their own smartphone operating system, which is Android. So simply just put it this way, Google is a combination of Facebook's ad space and Apple's operating system. Additionally, they are also competing in the fast-growing cloud computing segment, which they have quietly crept into the top 3 behind Amazon and Microsoft. The recent stock split announcement could also be a short-term catalyst. Interestingly, it seems like there is an underlying positive impact on investor psychology when it comes to stock split. It was noted that Apple, Nvidia and Tesla all saw their share price increase from the point of announcement till the date the stock is split. To also add on, stock split allows retail investors who have no access to fractional shares to purchase the stock at a more affordable price. But stock split aside, given Google's solid economy moat, dominant market position, excellent execution, increase in worldwide digital ad spending, and ad companies like Facebook and Snapchat fading off at least for this year, the current drop in the stock price really presents unique opportunity for investors to buy at a discount. Okay, the first not so hot stock is the internet favorite Palantir. Generally, Palantir's business is on a positive track, but I will not elaborate its growth story, as you can find 1001 videos on how good Palantir is on YouTube. Anyway, I think their products are really cool and their fundamentals are getting strong. But the issue is their stock is struggling badly, and there are some downsides that investors need to consider at least for the near term. Firstly, their year-over-year growth in the government sector has declined based on Q4 reports, though their business in the private sector is expanding. So here's the funny thing. In the past, investors used to complain about how Palantir is too dependent on the government sector. But now that the private sector is growing, yet the stock continues to face a sell-off. So it seems like investors are greedy. They want the company to excel on both ends. The next potential downside is that Palantir needs to execute and operate almost flawlessly for the stock price to fly. Any data breach will send the stock down south. Also, the company is still operating at a loss. And I know that tech firms operating at loss when they are scaling is normal, but I feel that in the short term, why not invest the money into elsewhere and come back again when they are profitable? Well, some may say that one shouldn't time the market, but hey, if the company's stock is obviously not performing, why keep DCA into it blindly? Even Cathie Wood is dumping the shares, and she actually bought the shares at a high price and disposed at a low price. So I think one should raise their knowledge and not their holding in companies like this. Do your research and not follow others blindly. For example, when the stock price was at $26, they say it is a good stock to invest in. Then it dropped to $18. That's when more people say that it's a good entry price. But the stock says, "Hold my beer, let me show you what I can do." And it further plummeted to $13. And then it's currently sitting at a dangerous position of $10 to $11 range. I wouldn't be surprised if it breaks below the IPO price of $10. Anyway, again, I'm not telling you to time the market. It's more of not to catch a falling knife. For me, I would want to see some sign of reversal in the stock chart, or when the company turns things around and become profitable, then maybe I would put my money in. I mean, I don't get it. Why so anxious in putting your money into a speculative, overhyped and unprofitable company, especially a non-public facing one? There are many other companies out there which are easier to understand. You can try asking retail investors who invested in this stock. Do they really know what the company is offering? Have they used its product? It's a lot of hearsay, like I heard from someone who worked in the force, in the army. I got some insider news. I have access to some PNC and classified info which I cannot share with you, etc. So in the near term, one can consider staying on the sidelines, watch how the company performs, see how the stock moves, and if it starts to fly, I don't think it will be too late for you to enter. Second not so hot stock, Grab. Let's dive straight to the key points. While Grab's potential is high, it also faces intense competition in all of its fields: ride-sharing, food delivery, and financial services. Most importantly, they don't have an economic moat that uniquely distinguish themselves from its competitors. It's becoming a little like jack of all trades, master of none. The slightly more promising segment is their ride-hailing service, as they are usually the go-to option, at least here in Singapore. That said, many other platforms and apps like Gojek, Tada Ride, etc. are up and coming in this country and region. With so many competitors, what unique selling point can Grab offer? Its large fleet of drivers? To me, that itself will not work and is not sustainable. Any disruptive method or promotions introduced by the other competitors will see Grab's market share fall. Anyway, look at TT Global and Uber in other countries and regions. They are barely surviving. I'm not confident in the upcoming earnings call. Speaking of which, ride-sharing companies have not been good investments so far, with Uber and Lyft both falling below their IPO price. So what makes you think Grab will be different? Well, maybe it will be, but definitely not in the near term. It won't be this year. Third stock, Alibaba. There's trouble written all over this company. Just a couple of days ago, Chinese authorities told the nation's state-owned firms and banks to do a round of checks on their financial exposure and other links to Ant Group, its subsidiaries, and even its shareholders. It seems like the Chinese government has some issues with Jack Ma and his companies, as the probe is believed to be led by the National Audit Office. We don't know how this will eventually pan out, but I would think it's better to stay clear and wait for the dust to settle. Then of course you throw in all the crackdown of tech firms in China, the failed IPO by Ant Group, etc. in the past. There are just too much dark clouds surrounding Jack Ma-led companies, which of course include Alibaba. Interestingly, Singapore state investment firm Temasek recently trimmed their positions in Baba and increased their stakes in rivals JD.com and Pinduoduo. Also, with so much noise and issues surrounding them, I personally do fear for the worst about Baba's earnings this year, as their attention may be shifted to tackle those problems. Anyway, their earnings call is coming up soon, and we all know that any subpar results will be punished by investors. So I think investors should adopt a cautious approach leading to its earnings date. Alright, that's all for this video. Are you invested in any of the stocks mentioned? Let me know in the comments section below. Lastly, thanks for watching my video. Hope you can like, share and subscribe to my channel to show a little support. Thank you.